Hey guys, I just want to talk today about what if HIMS turned on the money printing machine, ticker symbol HIMS. What if they reduced their marketing spend a lot in the future and they had a lot more free cash flow, their, by extension, EBITDA margin goes up a lot. What effect could that potentially have on the share price, So I just want to make a few remarks right here. Before I made a video saying that I think if everything else stays constant, if, the marketing spend, which is very high, that's, 30% year over year, and, it's going to keep on going higher likely because to attract new customers, you got to spend a lot on marketing. And I said that if, the marketing spend stays extremely high like what it is today, and we still have a price to sales ratio of about 4 is what it is right now, 4 to 5, how I think in 5 years, based off sandbagging revenue growth, we can hit around $140 share price, just with some simple math. And today I just want to talk about, well, what if HIMS decided, maybe 2028, 2029, 2030, that they just wanted to start the money printing? What if they said, hey, you can see right here, in 2023, they spent $446 million in marketing versus $270 million in 2022. You can see the first quarter of 2024 versus Q1 of 2023 have over a 30% increase in marketing spend, 130 million versus 97 million, right? So my line of thinking is in the future, and I said after 2024 we have 30% year-over-year subscriber growth, which guidance is much higher than that, and they beat guidance every single time for future outlooks. I have in 2030, assuming everything goes well, a little over 10 million subscribers. So what I wanted to say is that, if we keep up the marketing spend at this rate, how they've done it in the last couple of years, we get over $1 billion in marketing spend. But at one point, you don't need to market so much anymore because of economies of scale. You have inorganic growth at a certain point. It's probably earlier than 2030. You could argue that it's much sooner than later. But I'm going to say that, well, what if they decided to cut this marketing spend in half or in a third, right? Well, I just want to take a look at that scenario. In the case where you have $1 billion in marketing spend in 2030, assuming things keep going the way they are, well, if you have that, you have around over $500 million that's going to the bottom line. You can use that for share repurchases. You could potentially pay a dividend in the future. You could invest that into more products and growth. So that's just something to keep in mind. Another thing is I assumed here that, if the price to sales stays the same, it's because, the margin didn't improve, right? And the reason the margin would be so low is because they're spending so much on marketing. But if we reduce this marketing spend, 30, 50%, this margin is going to go up a lot, right? It's not going to be, they're guiding for 10 to 12% margins here. It's going to be a lot higher than 11% in the future. It's going to be in the 20s or 30s, right? When they decide to cut all those expenses because they start having inorganic growth because they have millions of subscribers. So naturally, because of that, the market is going to price it at a much higher price to sale. And I don't know exactly what the correct number would be, but I just wanted to kind of put that out there, is that if, the margins don't improve, which in my opinion is almost impossible, and why I say is impossible is that right now I'm not factoring any of the potential revenues from the weight loss drugs, but the weight loss drugs have great margins, right? So that's going to make this margin go a lot higher. When you reduce marketing spend, that's going to make this margin go a lot higher. So I mean, we could have, a 7 or 8 price to sales for this company. And, if we're thinking about $6 billion in revenues, well, then you're talking about potentially a $50 billion, $55 billion company. And if that was the case, this would be, probably $170, $180. So, I mean, I just wanted to put that out there is that, right now the margin is low. A lot of the reasoning is because you have this insane marketing spend, but it's the market. You shouldn't look at the marketing spend like a bad thing. You need this marketing expense to grow subscribers like crazy, and that's what they're doing. They're growing 46% year-over-year subscribers. This year, they're guiding over 40%. And every single quarter, they've been beating this. So I just really wanted to put that out there. Today, the stock's down a lot because of this short report, and there's some news about the weight loss medication. I don't think this changes the fundamentals of the business, but just putting that out there. I mean, this is still a very cheap business, and there's so much potential to trim fat, and in this case, the fat could be the market expense in a couple of years down the line. So I really think this is a 10-bagger. This is, you're just in the infancy of this business. So that's just my thoughts on what HIMS could do